Okay, let's dive right into this explainer. We're looking at the $39 trillion mortgage bailout. Now, according to newly surfaced documents, incoming Fed Chair Kevin Warsh has this plan to quietly cancel the government's massive debt. But here is the crazy part that most people completely miss. The exact same mechanism he's allegedly using, it's about to quietly cancel a piece of your fixed-rate mortgage too. $39 trillion. That's the current U.S. national debt that Warsh inherits on day one. And look, according to the source material, he's not going to just log into some government portal and hit delete to get rid of it, right? That's just not how debt cancellation works at this massive scale. And obviously, nobody's logging into your mortgage portal and hitting delete either. So how exactly does the government cancel this? Well, to understand it, we really have to look at the math. Because simply paying it off, the math literally doesn't work. The data points to this massive rollover of $9.2 trillion in net debt happening in 2025 alone. Just imagine if your own mortgage reset every single year to whatever the current street rate was. I mean, that's Washington's reality right now. Plus, a recent Congressional Budget Office receipt shows a terrifying trend. Interest on the national debt is on track to become the fastest growing major line item in the whole federal budget over the next decade. Not defense, not Medicare, just the interest.
Part 1. How dollars lose their charge.
Since they literally can't just pay the debt off, they have to use a totally different strategy. Think of the US dollar like a battery. The physical size of the battery, it doesn't change, right? But the charge inside, its actual purchasing power, quietly drains over time. So when the government drains the dollar of its power by letting inflation run hot, they actually drain the real weight of the debt too. You see, debt is really just somebody else's dollar. So to cancel a dollar of debt, you just strip it of its purchasing power. It's brilliant, really.
All right, part 2. The 1946 playbook.
Now, if you think this sounds like some wild, untested internet theory, the source confirms this exact strategy actually bailed out the US once before. Let's rewind to 1946, right after World War II. The federal debt had hit a whopping 106% of GDP. Newspapers and economists, they all swore we were going to default. But we didn't. Fast forward to 1974, and that debt dropped drastically, down to roughly 30% of GDP. So how did they pull that off? Well, the Treasury paid bondholders back exactly on schedule, but they paid them with weaker and weaker batteries. Throughout the 1950s, short-term rates were held down at just 1 to 2%, while inflation periodically spiked above 10%. The source explicitly names this tactic financial repression. This is basically when the Fed quietly holds interest rates lower than inflation. Going back to our battery analogy, they're speeding up the leak by charging your battery much slower than it naturally drains. And here is the absolute key detail you need to remember. Nobody votes on this. There are no laws being passed. It just happens because the Fed controls the leak. But here is where it gets really interesting.
This is absolutely not a conspiracy theory. It's a highly documented playbook that's currently being openly discussed by the smartest institutional money on the planet. I mean, look at BlackRock, the biggest asset manager globally. They published a paper in 2025 literally titled Financial Repression Past and Future. The Richmond Fed even released a retrospective on it. And a Columbia economist, Ricardo Reyes, wrote a working paper called Financial Repression in the 21st Century. They are actively and openly discussing this exact strategy.
And the quiet part? It's now being said out loud under oath. Just days ago, on April 20th, 2026, incoming Fed Chair Kevin Warsh told the Senate Banking Committee that a rigid 2% inflation target is asking for trouble. So what's the translation based on our source? Locking inflation at 2% means the batteries just don't leak fast enough to shrink that $39 trillion. He actively wants the batteries to leak harder and faster.
Which brings us to part 3. Who pays for this?
Because financial repression is pure math. You absolutely cannot shrink the real value of a massive national debt without somebody eating that loss. And the data shows a pretty brutal reality for savers. Just look at this table. If you have $100,000 sitting in a standard savings account at a big bank earning 0.01% APY, you earn roughly $10 a year. That buys you exactly one medium Starbucks iced coffee. Meanwhile, inflation hit a massive spike of 3.3% in March 2026, so your purchasing power is draining rapidly. While that exact same bank takes your $100,000 and lends it out for credit cards at 7 to 24%.
So the crucial point here is that responsible W-2 employees and diligent cash savers are the actual collateral damage. The source uses this perfect example of a grandmother in Toledo with $180,000 sitting in a standard Chase account at 0.01%. She is silently funding the national debt bailout. The mathematical reality is that the Fed absolutely needs you to earn less than inflation. Because if your battery charges faster than it leaks, the whole debt crisis just doesn't get solved.
Now for part 4, your personal mortgage bailout. Here's the surprising part, where the math actually flips in your favor. The exact same inflation that cancels the country's $39 trillion debt is going to cancel your mortgage too. Let's break down exactly how. If you hold a fixed-rate mortgage, your income generally scales up with inflation, right? Whether you own a small business and raise prices, or you get a W-2 cost of living raise, or maybe you collect higher rent on an investment property, you are taking in more dollars. But your biggest expense, that fixed-rate mortgage payment, stays exactly the same. The gap between your inflating income and your fixed debt widens every single year in your favor. You borrowed fresh batteries, and you actually get to hand back drained ones.
And according to the source's math, over 20 years of even moderate inflation, the real weight of that monthly mortgage payment shrinks by 50%. It literally becomes half as heavy on your wallet as it was the day you signed the papers. Now, we have to be clear and explicitly state what the source says about limitations here. This is an indirect byproduct. It's definitely not some deliberate gift from the government to you. And this strategy only works if you hold fixed-rate, long-term debt that's tied to a hard, appreciating real asset, like real estate. It absolutely does not work if you hold variable-rate debt, or, of course, if your income fails to scale with inflation over time.
Part 5. 3 moves to make today.
So what do you actually do right now to ensure you're on the side the Fed is actively helping? Well, the source outlines 3 specific data-backed steps you can take this week. Step 1. Pull up your amortization schedule. If your fixed mortgage rate is under 5%, the source actually suggests you stop accelerating your payoff. Don't send extra principal because you'd just be voluntarily handing the bank fresh batteries. Step 2. Check your savings rate. Get your cash out of those 0.01% big bank accounts and move it into high-yield savings accounts at online banks, which the source notes are currently paying around 4 to 5% APY. And Step 3. Safely learn how to access stored home equity and move it into hard, cash-flowing assets that charge themselves faster than the Fed can leak them.
Ultimately, the source leaves us with 2 distinct roads. You can follow the old rules, keep your cash earning virtually nothing, and let your savings quietly drain away as collateral damage, or you can leverage the 1946 playbook, really understand the reality of financial repression, and use the very same mechanism that's canceling the $39 trillion national debt to shrink your own. So, will you be the battery they leak, or will you position yourself to own the ones that charge themselves? Think about that as you review your accounts this week.